Welcome back to Firewatch Business, and I have the honor to talk with Nathan Turner, founder of Earnest Investing LP, and you also do the Diversified Mortgage Expo.
I do, yeah.
Which you just had your 10th annual just a few weeks ago.
Yeah, just about a week and a half ago, we just finished it up. So now I can breathe again, but yeah, it's good.
Do you move it around, or is it always in Nashville?
Always Nashville.
Why Nashville?
Well, a few reasons. So I actually just took it over 3 years ago. So this is our third year running it, but the 10th anniversary for the conference. And as I was taking it over, one of the things so I used to live in Montreal, and sometimes I would go out to conferences out somewhere on the Pacific coast somewhere. So it was always a 3-hour time difference. That's brutal. So I wanted something that was more central so that it was never more than a 2-hour time difference for anyone, easier to get to, that kind of thing. And then also as part of it, right away when I took it over, one of my first thoughts was I want to have an axe throwing tournament. And my brother-in-law, he actually started the sport of axe throwing. And then one of his locations was in Nashville. And so it fit. And so that's been a tradition here the last few years, and it's absolutely so much fun, and we have a blast. So
I did see on the itinerary, that's like day one, right?
That is, yeah. Just the night before we start the actual conference, it's just an open invitation, whoever wants to come, and those who want to sign up and throw, they can sign up and throw, but otherwise come and hang out. And what a great networking activity. You come and you just have fun, have some food, have some drinks, whatever. Get to know people before the conference even starts so that you can just dive right in.
That's beautiful. That is beautiful. Axe throwing is that we have an axe throwing place here, and of course it's a bar too. So that is kind of scary too in and of itself, right?
Yeah, yeah.
Serving a little alcohol with some
right, with some sharp objects. Yeah, no, what could go wrong?
You have a very interesting passive income situation.
Yeah.
How does it work?
So my business is I buy performing notes. And what that means is somebody's living in a house, they've got a loan on the property, a mortgage, deed of trust, contract for deed, whatever it is, but it's a loan against the property. The property is the collateral, and they're making that payment to the bank, to a private lender, whoever they're making the payment to. I come in and I talk to that lender and I say, are you willing to sell that loan over to me? And they'll do that because they would like a chunk of cash today instead of taking that payment over time. And I'm the opposite. I'm actually looking for that payment over time. So I'll step in, I'll buy it at some of a discount, and terms vary, and it makes a difference on the interest rate and where it is and all those different things. But essentially I'll go in and I'll buy the loan. So instead of buying the actual property, I just own the loan attached to that property, so that I can be that one stepping in and collecting those payments.
You said performing. Do you strictly look at performing loans rather than non-performing loans?
These days, yes. When I got started, my first note purchase was in 2010. And back then, that's pretty much all you could find were non-performing loans. Yeah. So over the years, I bought hundreds of them, but times have changed. I'm getting older. There's less availability of those non-performers. So all those things wrapped up into one. That's the focus now, is just performing.
So do you take the first position of a loan?
I'm a first guy. There's different opinions in the industry, and some people swear by seconds. I've got a friend who actually buys thirds or fourths, but I swear by the first. That's my niche. That's what I like to do.
So when you go to the bank that's holding the paper, you say, "Hey, I'm willing to buy it. Here's my rate that I would pay you for it." Yeah. And then they start mailing you a check.
Yeah, essentially, more often than not these days, when it's performing loans, banks typically don't sell those off. Certainly not, a few at a time. If they're going to sell off some performing loans, it's going to be in a package with 200 other loans, and you'll have to come up with a few $100 million to do that. And I don't have that. So I mostly buy seller finance paper, creative finance, owner finance, whatever you want to call it. That's typically what I buy these days.
Very interesting.
Yeah.
Very
and that's
so
it. The interesting thing to me is, so that's how I got started in the business actually was I had properties. I kind of thought I'd invented seller finance, and tell you the truth, and started selling his properties on terms and collecting monthly payments, but the borrower was the one taking care of the property. In my mind, like, oh, it's genius. Why doesn't everybody do this? Well, a lot of people do it actually, but I've kind of come full circle where now I'm on the other end of that. And when I first started, it was creating that note. And then I was actually looking for somebody like me that could cash me out and then have me, cashed out, and I can do whatever else I want to do with the cash. And that's where I'm at now. Is now I'm trying to educate those who are doing the seller finance. Did you know that there are people out there who will buy your note? And me and many others like me, but there's a strong following for that kind of thing. But a lot of seller finance people don't know that.
And is that what the expo does? Does the expo bring these people who have owner finance property in and say, okay, hey, let's look and meet others other than you, right? You have more than just you there buying paper.
Yeah, absolutely. Yeah, that's definitely one of the goals, is to get those two groups together, the creators and the buyers. Let's make some deals. Let's see what we can do, and who knows where it'll go from there. And ideally, I'm looking for somebody that does this as a business, where they're acquiring property, however they do it. They sell that property on terms, create a note, and then collect their down payment, collect a couple of payments if they want, but they can then sell me that note. And then they're cashed out. They can go back and do it again. We can keep each other very busy for a long time.
Yeah, no doubt. So this may be too much into the weeds, but what kind of discount are you giving these? What kind of discount are you getting for the loan? Is there a normal? There's no such thing as normal.
Not really, no. And we were kind of talking about this at the conference, and it was funny because so often, whether you're talking to a note investor or an attorney, it seems like the answer is always, it depends. And right. Which is a terrible answer, but it's an accurate answer. And then as we had more discussion, we added to that. So now it's it depends, or ask ChatGPT. So that's the new line. But it really does depend, because I'm buying for my fund, I'm buying at a 12% yield, which is not the same as ROI, but 12 yield. So one of the biggest determining factors is, what's the interest rate on the loan? Because if it's one of these, if it was originated back in 2020, 2021 at 3 or 4%, we're probably never going to get to a number that makes sense for both of us. If it's a seller finance deal that you're putting together today at 9 or 10%, my discount's going to be a lot smaller. That's going to be something where very likely we're going to be able to come to terms.
That's very interesting, because the interest rate is just all over the board right now.
Yes.
And we'll see what happens. I mean, the Fed. Now, how does that affect you in Canada? Is most of your properties in Canada?
Everything's in the US. I don't do
everything's
anything
in the US. So the Fed does matter what they do with interest rates to your business.
To an extent. Yeah, to an extent. And really, whatever happens today won't actually affect me for another year or 2 or 3. Because what I'm buying is an established set of terms. Whatever that loan agreement is, that stays the same. So if they agreed today to pay 9% because it's a seller finance deal and the bank's offering 7%, seller finance, you should be doing at least 9% in that case. If that's the case, then those are the terms. The interest rate is at 9%. The amortization is over 25, 30 years, whatever it is. And the payment is X amount. That doesn't change. Doesn't matter who owns the loan or who's receiving those payments. That doesn't make a difference. So what's kind of cool about that is, whatever's happening in the market, it's a very slow change when it gets to my level. We're looking at things that happened 2 or 3 years ago, which is another reason why bank paper right now really doesn't make a lot of sense, because so much of it was written at 3 or 4% back in those days.
Absolutely. There's just a low interest rate.
Yeah.
Interesting.
Yeah, so it doesn't make sense. We'll never come to terms. It's just, we're going to be too far apart.
Is the piece of property that you're buying, or not buying, you're buying the paper on, is that mostly residential, or is it anything can come in?
Anything could. I only buy residential. So that, and it's fun when we get together and kind of compare notes. Well, I only do residential. I've got friends that only do land. I've got other friends that only do commercial, and only seconds and this, that, and the other, or maybe a combination of those kinds of things. But everyone kind of has their preference, their own little niche. But that's mine. First lien. So that can be a mortgage, deed of trust, contract for deed, residential, property values typically between probably 75 on the low end, probably 250 on the high end, somewhere in that range. That's where I like to be.
So when people owner finance, to me, it seems like that person probably couldn't get a traditional mortgage and had to go through an owner financing deal. Is that basically true?
Yeah, most of the time that's typically how that goes. And why they didn't qualify to bank, well, that depends. Again, maybe they're an ITIN borrower. They're here in the country, they're legal, but they don't have a social security number. So bank's not going to touch them. Self-employed, we get that all the time where they're self-employed and banks don't know what to do with us. And so it just makes more sense to go with an owner finance. We get people where they've come from another country and they just don't trust banks in general. So they're willing to pay a higher interest rate just because they'd rather deal with an individual than a bank. So, everything else in between, there's all kinds of reasons. Sometimes it is bad credit, and that's fine too in my books, within reason, we look at it a case-by-case basis.
So, you're underwriting it, right? You're looking at it as an underwriter.
That's right. Yeah. Yeah. Ideally, when somebody's going through the process of doing a seller finance deal, ideally they're using an RMLO, like a registered mortgage loan originator. They will help do that underwriting to Dodd-Frank standards. And if you don't know what those words mean, that's okay. But there are standards out there that were put in place back in 2012, 2013, that we're all seller finance is the last one to kind of catch up with that, which is fine. But again, that's kind of one of those things we're trying to educate. If you're doing the seller finance, we'll pay you more if it's been done with an RMLO. That's going to be more valuable paper.
And every deal you do is collateralized by the home.
Yeah, that's right. Yeah.
So if your friend that's doing all the seconds,
yeah,
he's not as protected as you are.
No, and that's one of the reasons I don't like it. But I get it from his standpoint. He likes it where it's a lower price point. Generally, your second is going to be a smaller balance than the first, so it doesn't cost you as much. So you can spread out your risk a little more that way. The other thing is typically on those seconds, they're on nicer homes. Somebody with a $150,000 home, it's very unlikely that they're going to get a first and a second on that. So they're looking at more like $500,000 up. Somebody who had equity and then took out a loan against the property, a second loan against the property. And then again, in theory, that person who's living in the home has a little more attachment, for lack of a better word, to that property. So they're more likely to pay. Again, that's all kind of the theory behind it. I understand. I just don't like it. I like the protection of being in first.
Absolutely. And who services your loans? Are you servicing them?
No. Yeah, no, it's there's third-party services out there. There are other people that come to the conference and try to get clients and business. So just starting to use a company called Provident Loan Servicing, based out of Texas, but they're continuing to expand. They're almost in all 50 states at this point.
And they're great. Those people are collecting your money and then seeing who's in arrears and who they need to go after.
So they take care of a whole lot of that kind of thing. If there's any issues, at the very least, they can let me know, and we can work together to help get the person back on track, which most of the time works. The vast majority of cases, if we're doing a foreclosure, it's on a vacant property and they've passed away or abandoned the property or something. But almost always, if there's some kind of trouble, we can get them back on track. But yeah, and then the loan servicer, part of it also is, it's a third party. So if I'm collecting payments for a year, 2 years, 3 years, and I decide that I want to sell that loan, now I've got independent loan servicing that I can pass on to the next person and say, so, I'm not fudging the books on this. This is what the, independent third party is doing. And that's the records so that it can just help keep everything above board.
When they get behind, are you more lenient or more strict on them to get caught back up than like a traditional bank or a traditional mortgage would be?
Yeah, lenient is part of it, and creative is the other part, and just able. The where banks, they're locked into whatever their box is, and anything outside that box, that's really difficult for them to do because of regulations that they've created within their own organization. As an individual, man, we can do all kinds of things, and that's a conversation we'll have. So your payment was $800, it's not working for you. What can you do? What happened? Are you working again, or whatever the case is? What is a more affordable payment? And if they say, well, you know what, I could do $650. Okay, great. Then let's look at that. How can we make $650 a month work? And maybe we'll stretch out the amortization. We could raise the interest rate, perhaps. I've done all kinds. I've lowered interest rates, raised interest rates, stretched it out, shortened it. We can do whatever makes sense for both parties as long as we both agree and sign off on it. That's the new loan, and then we continue on from there.
Yeah, and that's one of the things that we did. We have a mortgage on my home through a traditional bank, and that's one of the things that we wanted to make sure of, that A, we could pay it off early, and then B, if we wanted to, we could recast it where we could put X number of dollars down and then recast it for the same amortization schedule, just to lower the payment in.
Yeah.
And you get to do that if they come to you and ask you, right? How many people are doing that, saying, hey, can I work through this without being behind or anything? Do they come and say, hey, I would like to increase my payments or pay a certain amount down, or does that just never happen?
Not generally, but it does happen in the opposite direction. I've had it where, for example, this was a few years back, but I remember there's one that one of my favorites, actually, my favorite stories of it was a seller finance note. I think it was 9%, maybe 9.9, so 9 or 10% interest rate. And this was back when rates were at, I think, 4 or 5. And so, and I knew he had a good pay history. I knew he was a good guy and was going to continue to make payments. So I approached him and said, can you just tell me, like, how's your credit score? Like, is it okay, or where are you at? And he's like, yeah, it's pretty decent. It was like around a 700. Like, I'll tell you what, why don't you go back to the bank, get financing from them, 4 or 5%, whatever they're going to charge you. It's going to save you a ton of money. So I actually went through the calculations with him and said, look, so here's your amortization schedule at 9% or 10 or whatever it was. Here's what it is at 4 or 5%. And just look at the difference. Like, you're going to save a ton of money. Your monthly payment can go down, and however that's structured, either way, you're going to save a bunch of money. And the reason I do that is because the earlier I get paid off, the higher my return goes. So it's definitely in my best interest to help him refinance. And in this case, it was a much lower rate, half the rate he was paying with me. And so win-win-win all the way around, and everybody's happy. So it's awesome when that happens. It doesn't happen often, but if there's a situation where I know I've had a few of those where I said, well, why don't you just go back to a bank and refinance? And they're like, oh, I can do that. Yeah, you can. And you should.
And you should. Yeah, please. Do it right now.
Yeah. Yeah.
So when you're looking at property and you're finding these deals, are people coming to you with these deals?
It's a little bit of both. Well, I just turned off my screen there for a second. There we go. Yeah, it's a little bit of both. I definitely, if people are reaching out to me, and I get a lot of that through the conference where people are saying, look, so I understand you're a buyer. And so, yes, I am. And so that's definitely part of it. And then it's, word of mouth, social media, and just letting people know that's what we're all about. And I'm, trying to connect with those who are teaching the seller finance side of things, and just letting them know, look, just another tool for the toolbox. If this is something that they want to do or they're interested in at some point in time, whether it's when it's a brand new note or they've been collecting for 5 or 10 years, there's a buyer for that, and they can get cashed out and go do whatever else they want to do with the cash.
Wow. So that is very interesting. Do you look at, like, when people bring you deals, I'm sure you have like a little checklist that you're looking at, and the type of properties that you want.
Yeah.
Is there a particular area in the country that you look, or do you have properties from California to New York and from Florida up to Minnesota?
A lot of different areas. So, and it's It tends to be with my price points where I'm looking for those kind of values and things. It tends to be kind of the eastern half of the country. So, but that's, Michigan down to Texas and everything in between there, with the exception of New England. New England is tough, man. Like, it's just that whole northeast corner. All the news, New Jersey, New York, those places, that it's rough. And the reason being is if I do need to go to foreclosure, it takes forever. I had one in Maine that took like 3 years to get through to a foreclosure, and they just have weird laws and strange procedures that just drag it out. And again, this is on a vacant property, but it's just going on forever. And meanwhile, the property's sitting there getting in worse and worse shape. And, there's only so much we can do to protect the property. Anyway, so I try to stay away from those areas. Sometimes I get tempted by really good deals, but in general, I mostly stay away, especially from that Northeast.
Yeah, I stay away from the Northeast too.
Yeah.
I don't have to go up there. It's too cold anyway, right?
Yeah, right.
I mean, I live on the Gulf Coast, so I like it where it's warm, no snow.
There you go.
That's all good. So, and you said your price point's like up to $250,000, and that could be with a home or vacant property.
I do. There's at least has to be a home on there. There's some good deals on land notes. It's just not something I'm comfortable with. I don't have very much experience in it. And so I'm curious. I'll probably do some land notes at some point, sometime. I've got a good friend who does mobile home notes, and same thing. The returns look great. I just haven't gotten my head around it just yet, but I'm sure I will. At some point here, I'll be buying some mobile home notes or land notes, or who knows? We'll see.
Yeah, I mean, down where we live, mobile home parks are just like huge. Mm-hmm. Obviously, I live in Alabama. And then also RV parks down here are just, I mean, they're building new RV parks all the time, which is just crazy.
Yeah.
And people either lease the lot, but some people buy their property in there.
Yeah. Yeah.
Very interesting.
Lots of opportunity. Anywhere you turn.
There really is. It's all over the place.
Yeah.
So when we look at, and you are a passive income, you consider this passive income, right?
Mostly passive. There's less work. So compared to what, like I say, when I first got started in 2010 buying non-performing, that's much more labor intensive. Much. There's a lot more from the get-go. I mean, you can't just have it sitting there and not making any payments. So there's something you have to do, whether that's talking to borrowers or doing a foreclosure and talking to attorneys, and then with the realtors to try to sell the property, and just put all those pieces together. And, all of a sudden the foreclosure takes a left turn and it can go all over the place. So that's way more time intensive, labor intensive. About a little over a year ago, we actually put together an investment fund, and that's what we're working on now. So just in the management side of it, and just that labor intensiveness, it's much less. And I won't say it's zero, because there's always something to do and there's always, things to take care of and whatever. But especially for the investors into the fund, that's about as passive as you can get. You'll get your report every quarter and along with the check, and go, great. And you can review it, and if you've got questions, that's great. But that's probably about as passive as it can get. But then on my side, there's a little bit more management. And then if you want to keep going, you can get as active as you want, but just depends on what you're looking for.
So the investment fund that you're doing now, you have people say, okay, I'm an accredited investor. Mm-hmm. I'm ready to put some money in with you. Are y'all adding properties and deleting properties all the time out of that fund? Or is it something that is held, are the terms of the investment, like, we will hold this property for X number of days or X number of months or X number of years?
Yeah. So we buy two different kinds of notes. So I'll buy either really short term or really long term. So the really short term are like the hard money loans, 6 to 18 months kind of thing. Those ones, they're great for the fund because they're in the fund, they're making monthly payments. And then once they're done with their project, I get all the capital back. Great. Then I can go out and turn it around and do something else with it. The long-term ones, again, I really like those, but they take a little more work, because I'm looking at, let's call it a 30-year loan, and the unpaid balance is $100,000. I'm paying I don't know, 75, 80,000, depending on terms and all those kinds of things. But just for an easy number, let's call it 75. I'm looking at that and saying, okay, after 2 years of payments, that principal balance has gone from 100 down to 99.5, 99.3, something like that. At what point does it drop to where I can still resell it for that original 75? So that I can, again, take my capital back out and then turn it back into something else. So there is a bit of an ongoing, in and out in that sense on the management of the notes. For the investor, it's pretty open. When we first set it up, we had like a minimum time. We took that away because we thought, you know what, if you want to stay in it, stay in it. If you don't, that's fine. The understanding is it's all tied up in the notes. So if you have $100,000, $200,000 in there and say, I want to get my money out, that's great. I need at least, I'm going to say 30 days, 30 to 60 days. I got to sell some of those notes to get the capital back out and get you paid out. But it's, relatively liquid. If you're looking to get your capital back out, that's not too hard.
So when do you still have the freedom to work with the borrowers, even in the investment fund, like you do if you bought it yourself?
Yeah, in the fund, I lean a little bit more on the servicers in that case, but I like to have those conversations directly with the borrowers, just because it's more efficient than anything else. When we've got a servicer in the middle and it's just passing messages back and forth, that just gets cumbersome.
Yeah. Whereas
we can have one conversation and just figure out, what's the new deal? If it's going to be a new deal, what's the new deal? In half an hour conversation, we can come to terms and say, okay, great, we'll send you paperwork, sign it, send it back, and we're done. Instead of, well, they said this, and so then I'm going to say this, and then they're going to say that, and it's just inefficient.
So, the investment fund is not passive to you at all. You're working it all the time.
Yeah. There's things to do.
But for the investor, it's passive.
Yeah, exactly. No, and this is my work, and I love doing it, and so that's just fine with me. But yeah, for the investor, they're far more passive than I am in this case.
Right. So you said you got your first property in 2010, like during that whole financial debacle, right?
Yeah.
And it was non-performing.
Yeah.
What just came up to you and said, yeah, this is what I'm going to do?
Well, we've got to back up a little bit more. So I had gotten involved with a group. They had bought a bunch of properties, 60 properties, centered mostly in the Midwest, and did that so they bought it in 2007 with the intent of just flipping out that portfolio to somebody else. Of course, that deal went sideways. By the fall of 2008, I get a phone call and said, hey, we're looking for some help in just figuring this stuff out. Do you want to help? And, at the time, I didn't know anything about notes. I had some real estate background, but I had some time. I just sold the business. So sure, let's do it. So that's how I got involved. And that's when I thought we'd invented seller finance. We're selling these properties. It was me and my old partner, and we're selling these properties on terms and, collecting a small down payment. We really didn't know how to underwrite borrowers at all. And the paperwork was not nearly what I would consider good today. But it was a good start. It's something that we got going. And then that's how I kind of got introduced into this world of note investors. I was looking for a back end, somewhere where I could sell these loans and cash out, because I got to get these investors cashed out. So that was the introduction, just really, really organic. And went and took a class, learned about what they called a bad paper or non-performing or whatever it was, the term they used, but that idea. And I thought, oh, that's interesting. I'm not so sure. But then I had this opportunity in 2010, 3 loans for a total of $10,000, all in Columbus, Ohio. And that's kind of where we were working at the time. And so I thought, it's a $10,000 experiment. Let's give it a shot. And I was blown away. We were still trying to get the property. I was still much more in a property mindset. So it was 2 of the people still lived locally. The properties were vacant. They had bought them at the time, it was a good idea, but they bought them as rental properties that they were going to just own as a second home, rent it out, and, no money down in 2006 and whatever, all these things. And so at the time, it was a great idea. And then by the time I got involved, they were completely underwater, panicked and not sure what to do with this. They know they've got this property that's worth way less than what they originally thought. And now they've got this loan out there and. So I knock on the door and I say, okay, well, I'm here. I now own the loan, but I'm not here to collect any money. I just want the property. If you just sign it over to me, we'll make the loan disappear. And the first guy was a retired vet, and he was like, absolutely. Where do I sign? The second one is this younger girl. She's in her early 20s. And same, bought it as this income property. It went totally south. Her and her boyfriend split up by that point. It was a mess. So I said, I'm here. I'm not here to collect any money. I just want the property. If you sign it over, we'll get rid of the loan. And she gets in tears and she's all crying. She's like, are you serious? You'll do that? And I at that point, I hadn't considered that I was helping anybody by doing what I was doing. And so that was really eye-opening to think, wow, I'm out here solving problems. I'm really helping people that are in a real pickle get out of whatever jam they're in. And so that was huge. That was a real eye-opening experience for me. And then just went from there. Got introduced to people that were in the business and went to my first conference, 2009, fall of 2009, and unbelievable. There's people that do this. This is a community. No way. And just that was the intro. Went from there.
How valuable is the conference you went to, and now the conference that you run? How valuable is that?
Yeah, I know, and I say this to people all the time. I know it sounds like a commercial now that I have my own conference, but I'll tell you, this is how the business is done. From my very first one in 2009, you start to meet people. And in fact, this last conference, somebody I'd met at that original conference in 2009, I called him up to be a speaker at my conference. Now that, 15, 16 years later, unfortunately, he's older and he's like, it's just not in me anymore, but here's a colleague, call him. And so sure enough, he came out and gave a really cool talk about buying structured settlements. And I thought that was so cool. And so just a different kind of a note, buying a judgment or lottery winnings or something like that. But anyway, really cool. But all the way back to 2009, where I met this guy and I thought, oh, that'd be cool. And we'd done some business over the years and wanted to see if he wanted to come out, but that's how it goes. It's all about who you know and the network and who knows you. That's just how it's done. That's how the business works. So you got to get out there. I would way rather stay at home and just curl up on the couch, but that's not how the job is put together. You got to get out there and talk to people.
And it really is. And I don't think people really understand that. I mean, as you know, this channel is all about small business. It's all about 9-to-5ers trying to get to a point where they can quit their 9-to-5 and do that via side hustle. It's so amazing and important for you to get out there and just talk to somebody.
Yeah.
You got to figure out what their pain points are so that you can solve the problem. Here you are solving this poor young lady's problem, and she's thrilled to do it.
Yeah. Yeah. Which it never dawned on me that I was solving a problem, but then here we are. And literally she's breaking down in tears and I'm getting all choked up and everything. I'm like, wow, this is amazing. Look at this.
So if there's an owner, if there's somebody that has owner that they are toting a note for somebody right now on property, that's something that you may be interested in depending on the tenant, the home, and the location.
Yeah, absolutely. Absolutely. And it's so interesting getting into this where I'm, the property is great and that's the collateral. So I'm definitely interested in what the value is. But what I'm actually interested in is what are the note numbers? So what's the interest rate? When's the first day that they started making payments? How many payments have they made? How many payments remaining? Like all of those numbers are far more interesting to me. I just need to know that the value is what we think it is on the property. That's it. And, granite countertops, Formica, I don't actually care. I just need to know what's the value today.
Yeah, we talk about that a lot. People who are trying to flip homes or look into doing residential rental, which is a tough business. And we talk about that all the time because really the only thing that's going to increase a home's value is square footage.
Yeah, that's pretty much it.
Yeah. I mean, they don't care about whether it's Formica or if it's granite. It's just important to.
Not really.
Yeah.
Here's my secret insider tip for anybody who's flipping.
Yeah. Okay. I'm ready.
That's how I first got started was flipping property back in 05, 06. And I had, rules. So rule number one, never open a wall. If you know what's back there, then you have to disclose it. And it's much more work potentially. And so if I don't know that there's something else in there, and maybe that's slimy, I don't know, but you get into a lot of unknown expenses as soon as you open that wall. Number two, there's ways. So the kitchen and bathroom, they don't necessarily increase the value of the property, and that can go with pretty much any repair. Actually, there are things that could increase the value. There's other things that will just make it easier to sell. And that's what I figured out pretty early on is I'm not necessarily trying to increase the value, but I am trying to make it easier to sell. And looking pretty and all those things, that's important because it makes it easier to sell, and it'll just sell faster, and time is money at that point. And then the last thing I would say is what I figured out to do on the countertops, and I don't even know if they make it anymore, but it was, I'd have to go back and find it, but it was a product where it was these little tiny beads, and I would trowel it on to the countertop, and then they had a urethane finish that would go over top of it. So it made it look really nice and fancy and shiny, but it was far less expensive than any kind of stone, and it looked a little nicer than Formica, and so it worked. So you can do a lot with a little, and that's for the flipping people. It's a great business. I love doing that too, but it's been a while.
That's wild. That is absolutely wild. Oh my goodness. Well, Nathan, I don't know, we've been on here for a little bit, and I just appreciate your time, and I don't want to keep you too late, but it's very interesting. If you are an accredited investor and you are looking to invest, are you still looking for investors now into the fund?
Yeah, absolutely. Yeah. Looking for accredited investors. And then more than happy to have a conversation, just make sure the goals align. I'm not trying to take your money. I'm just saying, let's figure out if this is a good investment for you. It works great for cash on hand. It works, I would say, even better for IRA cash. If you've got money sitting in an IRA that's doing less than 8%, let's have a conversation, see if we can help you out.
Oh, that's interesting. Less than 8%. Mm-hmm. Very, very interesting.
Yeah.
All right, man. Anything that we didn't talk about that we should have tonight? What was your favorite place in Nashville? What is your favorite place to go in Nashville? You know what?
Broadway is a lot of fun. I'm not really into the party scene anymore, and so it's loud. And if loud's what you're looking for, you'll have a blast. I really like barbecue, and so Edley's is one of my favorites. And this last time we went, what did I have? I had the turkey, I think it was, the smoked turkey, and man, that was good. And then I've had the catfish there. That's really good. The ribs, of course, are delicious. Brisket's fantastic. Love the banana pudding. Yes. Just, anything there pretty much goes. So that's one of my favorites. I want to make sure I get to Edley's for sure.
That's great, man. I love Nashville. We go up there for the IndyCar race or the NASCAR race. My wife and I are big race fans, so we go up there for that every once in a while.
Nice.
But yeah, Broadway's getting more and more like Bourbon Street to me.
It's loud and crazy and busy, and like I say, if you're into that, you'll have a blast.
Yeah, no doubt. Well, Nathan, thank you so much for your time, man. I appreciate it, and appreciate you giving some great insight to us.
My pleasure. Thank you.
And thanks for coming on.
You bet.